Greetings, members, one and all of the Salivation Nation, on the eve of Basel III, gold market shakeup, and why prices may not rise. Let's explore! In a prior video, I discussed Basel III and why I didn't think that the prices of gold would go up because of some deadlines coming up. Well, we are at the eve of those deadlines. And we're going to take a little bit of a deeper dive. I think this is a fairly well-written article that explains Basel III regulations, but we want to visit it from a standpoint of the phasing in. Basel III regulations won't be fully phased in until January of next year, but there's been a lot that has already been phased in since the financial crisis of 2007 and 2008. Let's get into this, and we'll talk a little bit about why prices may not rise. But I could be wrong about that. European banks face beefed up liquidity requirements under what's known as the net stable funding ratio on the 28th of June, which is on Monday. New banking rules as part of a sweeping international accord known as Basel III will come into effect on Monday and mark a big change for European banks in their dealings with gold, potentially altering the landscape for precious metal demand and prices. And I do believe that will be the case to a point, but probably not immediately. Like many reforms put in place over the past decade that aim to avert another global financial crisis, the new banking rules come with some controversy and caveats. Allocated gold in tangible form will essentially be classified as a zero-risk asset under the new rules. Well, technically, in April of 2019, gold did become this Tier 1 asset. More on that here down below. Unallocated or paper gold, which banks typically deal with the most, won't, meaning banks holding paper gold must also hold extra reserves against it. In other words, they got to back up their paper gold. From Brian Lunden, editor of Gold Newsletter. The new liquidity requirements aim to prevent dealers and banks from simply saying they have the gold or having more than one owner for the gold they have on the balance sheet. It's crazy. And in this market, we are literally seeing derivatives piled up on top of derivatives. It's absolutely insane. So in a sense, this is a good thing. In response to the global financial crisis from 2007 to 2009, the Basel Committee on Banking Supervision, which sets standards for regulation of banks, developed what is called Basel III. It's defined by the Bank for International Settlements as an internationally agreed set of measures that aim to strengthen bank regulation, supervision, and risk management. Think of the Bank of International Settlements as a central bank for central bankers. In its essence, Basel III is a multi-year regime change that aims to prevent another global banking crisis by requiring banks to hold more stable assets and fewer ones deemed risky. And that is gold is probably the least risky asset out there. Although, as I mentioned in a prior video, there is some risk involved. I'll put a link to that video at the end screen of this video. Under the new regime, physical or allocated gold, like bars and coins, will be reclassified from a Tier 3 asset, the riskiest asset class, to a Tier 1 zero-risk asset, putting it right alongside with cash and currencies as an asset class. Well, with modern monetary theory and with all the printing and liquidity that's out there in terms of cash, well, I don't know that that's necessarily a good thing. And so it's very interesting to see how that plays out. Since physical gold will have a risk-free status, this could cause banks around the world to continue to buy more, Coos said, adding that central banks already have stepped up purchases of physical gold to be held in the institution's vaults and not held in unallocated or paper form. And we've seen that for a couple of years. I've definitely discussed it. Nations like Poland, Turkey, China, Russia have been adding gold to their reserves. The United States has not, although we have well over 8,000 tons of it. But I digress. Some people question that if we have any. Allocated gold is owned directly by an investor in physical form, such as coins or bars. Unallocated gold or paper contracts often are owned by banks, but investors are entitled to that gold and avoid storage and delivery fees. Under the new rules, paper gold would be classified as more risky than physical gold and no longer counted as an asset equal to gold bars or coins. And that's a good thing to have that distinction, because really, you got to back it up by the physical. You know the old adage, if you don't hold it, you don't own it. So as part of these reforms for Basel III, European banks, not U.S. banks or Canadian banks, will face new liquidity requirements known as the Net Stable Funding Ratio, the NSFR. It's a liquidity standard that banks must follow to ensure adequate stable funding to cover their long-term assets. The ratio is the amount of available stable funding relative to the amount of required stable funding, which should be equal to at least 100% on an ongoing basis. NSFR regulations will be introduced to banks in the European Union, only the European Union, on Monday, the 28th of June. The United States will on July the 1st. So it will be coming very quickly to the United States and then complete with the United Kingdom on January the 1st, 2022, according to Alistair McLeod, head of research at Gold Money Inc. The objective of the NSFR is to oblige banks to finance long-term assets with long-term money. Now, it doesn't get any more long-term than gold, in my opinion. To avoid liquidity failures that were seen during the 2007-2008 global financial crisis, according to the London Bullion Market Association, which, by the way, made news again from an egregious accounting error that miscalculated the amount of gold and silver that they had in their holdings. It affects all bank liabilities and assets, and the objective is to ensure that bank assets are properly funded and the depositor withdrawals will not lead to bank insolvency and the transmission of systematic risk, said McLeod. The new rules will mainly impact banks and their unallocated gold, as the majority of regular investors tend to hold physical allocated gold, analysts have said. Unless they're buying ETFs. And it'll be interesting to see how that paper to physical ratio will be adjusted under this new system. New liquidity ratio requirements imply that banks may need to set aside more funding for unallocated gold, analysts at Bank of America Global wrote in a note on Monday. Raising funding requirements for unallocated gold means that financial institutions would either reduce the bullion business or sustain activity and put more funding aside, said analysts at Bank of America. I think this stuff does give them some wiggle room. In fact, a lot of these banks, they may not have a whole lot of trouble finding that cash. I mean, good grief, J.P. Morgan was fined almost $1 billion for a manipulation of silver and gold prices, and that's money that they're not going to see again. Pocket change. More likely they can probably come up with some of that money, at least some of it. I don't think it's going to hurt them too much, in other words, which is one of the reasons why I don't think it's going to have that big of an impact on gold and silver prices, at least right away. These two options have slightly different implications for the gold market, ranging from a reduction in liquidity to rising costs for market participants, the analyst said. Either way, they do not believe these dynamics are bullish for gold. I tend to agree with them. Also, it's unlikely that banks would replace usage of unallocated gold by gold purchased outright. So think about that again. It's unlikely that banks would replace usage of unallocated gold by gold purchased outright. I don't think it's going to be just some magical switchover. In the past, banks have dealt with unallocated gold because it makes trading the metal easier. And that it does. Unallocated gold provides the most convenient, cheapest, and effective way for trades to be done between professional counterparts rather than having to move physical bars against each trade, said Ross Norman, Chief Executive Officer at Metals Daily. It's primarily an interbank mechanism to help professional participants with clearing and settlements of trades. Under the NSFR rules, however, unallocated gold goes into the balance sheet of the banks involved, and the rules propose to make it much more expensive for banks to hold unallocated gold balances, said Norman. The rules will not only make the cost of clearing and settling trades more expensive, but the lending of precious metals to industrial counterparts, including miners, refiners, and fabricators, will become much more expensive as the costs get pushed down the value chain. It follows the proposed changes will make dealing in gold much more expensive for everyone in the sector. Even those acquiring physical bars, it could make the market smaller, Norman said. All in all, the changes are retrograde, may render gold less relevant as an investable asset. Now, that is an interesting analysis to see how it can make gold more expensive in that way. My feeling is for the unallocated gold, if you have it match up and backed by the physical, you could still trade it without moving the gold around. So I don't see how that would have an effect. And for totally unallocated gold, like if you can't back it up, well, you have the cash to back it up. I don't know. And it is more risky, which makes it more expensive. But that's for unallocated gold. If they make it all allocate or have these paper contracts backed by the physical, kind of like Sprott's PSLV, where every ounce of silver is backed or every paper trade is backed by the equal amount in silver. How is that going to hurt anything or hurt the price? If a physical gold broker's cost of financing his stock of coins and bars, for example, doubles, then it's likely he'll hold less inventory and charge higher premiums for his products, Norman explained. If financial markets become stressed and gold demand rises sharply, then physical supply would be greatly constrained. You've just burned half of your lifeboat. In turn, that will make gold less attractive as a safe haven. In a recent letter to the impact of the NSFR on the precious metals markets, the LBMA and World Gold Council said the proposals under the NSFR failed to take into account the damaging effect that the rules will have on precious metals clearing and settlement system, potentially undermining the system completely, and on the increased cost of financing of precious metals production. I kind of don't understand that because obviously, the LBMA has been under some criticism, and I think some of it's legitimate, same with the COMEX, about their holdings. Now, obviously, gold and silver move in and out of those organizations all the time, but the accounting of it is a bit fuzzy at times, and I think part of that is because some of this paper system, some of these derivatives are there. The majority of precious metals held by the LBMA Clearing Limited, which was created by the LBMA and operates the clearing and settlement of precious metals, is unallocated metal. And I don't think there should be unallocated metal. I just don't believe in that. It should be allocated. That's when we buy gold in whatever form, there should be the gold to back it up. Because then if you don't, and it increases, like we have seen so many times, we all know for all of these commodities, it's not just gold and silver, it's every commodity out there. There's much more of the paper than there is the commodity to back it up. That's derivatives, and it is something that is ripe for corruption. And we know it has been corrupted and for a crash. And it's kind of like what we saw with the financial crisis. But I digress. I don't know if the Basel III rules are completely the right way to go. There's probably a lot of nuance and a lot of detail in it that I don't completely understand. But I do believe that the Tier 1 asset designation is a good thing. The vast majority of gold trading takes place in the London bullion market. The regulations are expected to take hold in the UK at the start of the new year, so a real impact won't be seen this month. So really January is when it's all going to come. Like I said, a lot of this has been phased in. leading up to this point, and this is the final phase, I guess. So the gold market impact analysts differ greatly when it comes to their options on the impact of Basel III and NSFR requirements on the gold market. Gold Money's McLeod expects banks to be discouraged from dealings in gold forward contracts in London and future contracts on COMEX. That can lead to greater price volatility, and at the margin, some bank customers who have had unallocated gold and silver accounts will seek to maintain their exposure by buying physical bullion. And so that could essentially drive the price up. These new changes also come at a time of accelerated monetary inflation, and it's very likely that the combination of the two events will drive prices higher, McLeod said. How much higher depends on how weak the dollar becomes in terms of its purchasing power. So in that way, I think the combination of, but not necessarily Basel III itself, will cause it to go up, but because of the combination of that, maybe accelerating the prices to go up because of inflation. And so we did see gold go up to $2,069 an ounce on the COMEX, but they've dropped 14% since then. Norman, however, thinks the new rules will not have any significant effect on gold prices, only on the cost of dealings in these markets, and I tend to agree with that. At least not right away will it have much of an effect. But Gold Newsletters London seems to explain it best. The range of opinions on the matter extend from no effect on one side to absolute mayhem on the other, peppered with I believe it when I see it attitude. The implementation of Basel III rules has been postponed so many times, there's still lingering doubt it's going to actually happen. So we don't know on the eve of Basel III, Monday when it's coming, there could be a late Sunday night delay. We'll watch these markets. I do a live stream every Sunday night, and we check the markets. And I believe this Sunday night, considering what could happen behind the scenes, there will be either some activity or maybe even the prices go down because of it being delayed. If they're delayed, I could see the prices going down for gold and silver. But I do think if gold rises because of this, I think silver will fall right alongside it. London also has said he does not believe the bullion market and central banks would allow these regulations to interfere with the system they have set up, but he holds out hopes that they will. So very interesting. I thought this was a well-done article. I do sense a little bit of bias in it. It is coming from MarketWatch, but nonetheless, it'll be very interesting to see how it plays out. I think we should be prepared for either scenario, however that may play out. But I think the other reason why the prices may not rise is because really the biggest driver of the price of gold and silver is a dollar index. And I think there's just enough removed from that dollar index, and given where the physical investment aspect of the gold market is, and most of the gold market in the physical form is in the form of jewelry, that it's likely to have very little effect. So even if it's coming to effect, even after January 1st of next year, when it's fully implemented for all the banks, I don't think we're going to see a whole lot of movement necessarily because of this. Now, during the next year and in 2023, that may be a different story. Some of the stuff mentioned in this article may come to pass during that period of time. We'll find out. But anyways, I hope you found this video insightful. Let me know your thoughts in the comment section below. Would like to extend a multitude of gratitude to you all for taking the time to watch, and encourage you to please rate, share, comment, and subscribe.